Since the adoption of the Paris Agreement, there's been a lot of interest on the part of investors for integrating climate change discussions, dimensions into investment management. And in the wake of the special report of the IPCC on 1.5 degrees Celsius of warming, there's been an uptick in investors committing to Paris alignment and net zero investing. What that means exactly is still a work in progress, but there has been considerable progress over the course of last year with the launch of a EU Paris-aligned benchmark label and the release by two investor associations of net zero investment frameworks. So the objectives for this seminar today is to go over these frameworks, look at how they're supposed to impact emissions in the real world, and discuss some implications for investment management. So I'll start by covering some vocabulary in respect to Paris alignment and net zero. As you probably know, the global warming mitigation objectives of the Paris Agreement require the emissions to peak as soon as possible and then decrease rapidly so that they can be offset by a sink of greenhouse gases in the second half of this century. And if you want to achieve the higher ambition of the Paris Agreement, the 1.5 degrees Celsius of warming, then this net zero objectives of seeing the emissions compensated by the natural or artificial sinks need to happen by mid-century. There are different ways to get to 1.5 degree and net zero, and they differ by the speed of the emissions reductions and the role of the negative emissions technology, those sinks pumping greenhouse gases, especially carbon dioxide, out of the atmosphere. Since many of these negative emissions technologies are still unproven at scale, the more conservative scenarios will put the emphasis on decarbonization and make very limited use of negative emissions technology. In terms of translating the net zero objective into emissions reductions, we're talking about 7.6% per annum over the next decade to have a 2/3 chance of keeping warming within the 1.5 Celsius objective. This obviously is a global target across countries and sectors, and has to be broken down into sector targets to reflect the different challenges of different sectors with respect to carbon abatement, and also into regional targets to reflect the different challenges of countries and leave higher budget for those developing countries. So the Paris Agreement, as you know, calls on states to make finance flows consistent with the climate change mitigation and adaptation objectives, but it does not directly apply to investors. There are multiple strategies taking climate change into account out there, which are motivated by different objectives. It can be simply deontological, where the investor wants to disassociate from the worst climate offenders. It can be consequentialist, where the investor wishes to have a positive impact and contribute to the fight against climate change. Or it can simply be business as usual, taking into account climate change risks to adapt the risk-return profile of the portfolio. These are the objectives. Now you can have some design and methodology issues that can frustrate these objectives and create some unwanted risks. You may have unwanted climate risks arising from poor usage of data or improper metrics. that are unfit for purpose. You may have financial risks arising from concentration or sector or factor biases, as we often see with ESG strategies. Or you may have greenwashing risks, which refer to claims made by the strategies not being backed by what the strategy is actually doing, so misrepresentation of the green credentials of the strategies. So you have all kinds of climate strategies out there with different goals, different methodologies, and therefore different alignment with the Paris Agreement. And due to this accumulation of divergent strategies and the risk of greenwashing and mis-selling, the European Commission has decided to create standards for Paris-aligned benchmarks. So this was finalized in July of 2020, and the act became law in December of 2020, so at the turn of last year. These minimum standards defined by the EU regulation center on portfolio level metrics, where the weighted average carbon intensity of the portfolio of the index has to be reduced by 50% upfront relative to the underlying market, and has to fall by 7% per annum, which is consistent with a 1.5 degrees Celsius pathway. Also, there is a limitation to try and control decarbonization through cross-sector allocations that require the strategy to keep its exposure to key transition sectors in line or higher than that of the market benchmarks. So there are some good aspects and bad aspects with these standards. The positives, or the main positive, is that there is this pathway for the portfolio to decarbonize at a 7% per annum speed, which is consistent with an ambitious 1.5 degrees Celsius scenario. So that's positive. Now there are some ambiguous elements in the standards. It's all centered on current emissions intensity. So at least this is something that is relatively solid. But at the same time, this is the only criterion that is taken into account, and other possible alignment criteria like commitments by companies or investments made to align the company with the decarbonization scenarios are disregarded in this standard. Then there are some clear negatives. There is a lack of granularity in terms of sector constraints. There is an overall need to maintain the cumulative exposure to a key transition sector at the level of the benchmark, but you may reallocate within key transition sectors across sectors, and it may be very easy to decarbonize your portfolio by simply under investing in the higher carbon intensity sectors like electricity, and we see this a lot in the implementation of this standard. So this type of portfolio construction, cross-sector allocations, shenanigans are not very conducive to supporting the real economy and supporting change in the real economy across sectors. Then there is this steering of decarbonization by a carbon intensity that is defined in relation to enterprise value, that promotes the adoption of a similar metric at the level of the assets for selection of assets. And this means that the assets will be selected to achieve the portfolio level objective more based on their capital market performance than their carbon emissions control performance. So this use of a emissions to enterprise value metric to steer the decarbonization of the portfolio will do very little to incentive the reward of carbon decarbonization by corporates, by individual assets. So these minimum standards defined by the European regulation cannot serve as a hallmark of quality for the integration of climate issues, and this is true whether you are thinking in terms of financial objectives, as the risk may not be properly managed, but also in terms of non-financial objectives, in terms of promoting a real change in the economy. You can end up with benchmarks that disregard entire sectors, that allocate to individual assets purely to make the portfolio objectives without regards for the carbon performance of assets. So it's not something that will guarantee that you have a sound strategy that will have an impact. So we have been quite vocal about the limitations of the regulation, and judging from a recent article by Risk.net, more and more investors are aware of the limitations of the standards, and that's one of the reasons why we've seen investor coalitions come up with their own standards for decarbonization. And in the course of 2021, two such coalitions have come up with standards. There's the Paris Aligned Investment Initiative that has released the Net Zero Investment Framework. Currently, about 50 asset owners controlling around 3 trillion of assets are engaged in the application of these standards. And then there has been the target setting protocol of the Net Zero Asset Owner Alliance that was released also in 2021 and has been updated earlier this year, and committing to this standard are 69 insurance and pension fund managers that collectively manage $10 trillion US. So some significant coalitions in terms of networks and investors signed up, and I will cover these standards in more detail. At a very high level, these standards have among their features to require portfolio level compressions in terms of emissions intensity that are consistent with 1.5 degrees Celsius scenarios. They intend to encourage decarbonization at the level of each key transition sectors. And they promote alignment and decarbonization down to the asset level, and they not only take into account current emissions performance but also forward-looking criteria. And they try and impact the real economy through investment by combining two tools: capital allocation and engagement. So that's how they intend to impact the real world emissions. So I'll say a few words about these investor impact channels before I get down and zoom on the frameworks themselves. So as you know, except perhaps in the case of real estate, investors do not have direct control over the climate performance of their assets, but they can nevertheless try and have an impact on the carbon performance and the climate performance of these assets by attempting to affect the issuer's ability to grow by varying the capital and the cost of capital of companies, or by directly or indirectly trying to influence investors to have them adopt better climate performance. So there are three investor impact channels that are recognized by the academic literature and also by these net zero investment frameworks. There are the capital allocation channel, where the idea is to have a quantitative impact on the funding conditions of companies by restricting their access to capital or trying to have an impact on the cost of capital. It can also be used, this capital allocation channels, to try and send signals to companies that suggesting that they improve their performance. So the signals that are market signals. Then the second investor impact channel is the direct engagement of companies. The idea there is to try and influence companies to improve their climate performance by a dialogue, as well as the exercise of shareholder voting. So this can be bilateral from investor to company, or multilateral, whereby investors in a coalition approach company or a company or companies to try and improve their performance. Finally, there's the engagement of other stakeholders that can also be relevant. The idea there is that you engage the regulators or the enforcement authorities, or the market as a whole, or the public, to try and alter the environment in which companies operate, to change the supply and demand for the products and services in a way that positively impact the environment, or try and impact funding conditions, authorized activities, performance level, etc. So that's another very powerful way of trying to impact companies working through change of the environment. I'll say a few words about academic literature on these investor channels, focusing on capital allocation and engagement. There is over 20 years of work on the possible impact of capital allocation on environmental performance, starting with Heinkel, that show that investors' decision to shun polluting firms will increase the cost of capital, and that will contribute to reducing the ability of companies to grow, especially when capital is scarce. And that this activity of shunning companies also incentivizes reform by companies. The idea being that by reforming, they are bringing back green investors and reduce their cost of capital or increase their share price. These model finds that the impact grows with the proportion of green investors in the economy and the consensus of these green investors. If they target the same companies, they will have collective impacts that will be felt more clearly. Obviously, the activity, the reform activity by companies will fall with the cost of these reforms, and it will also fall with the extent to which companies are substitutable, because the more substitutable companies are, the less the impact of shunning will have on the cost of capital. So this is the seminal contribution dating to 2001. There has been newfound interest in the area over the last 5 years with different models looking at asset pricing with climate preferences or climate risk integration. And these models that are more sophisticated in their approach get to similar conclusions. They find that the cost of capital will shift investment towards higher ESG performance, that the companies will be incentivized to reform and achieve higher performance to achieve higher market values. They find that the impact is a function of how much green investors control in terms of assets, how strong their preferences are, and how stringent their allocation is. As before, it is found that the impact is negatively linked to the cost of reform, to the standard cost of capital. The higher the cost faced by companies before investors take action, the less impact this action will have. They also find that where there is more risk uncertainty, there is less impact of investor action. What this suggests is that it's important to mobilize capital and focus investor action to try and impact the practices of companies. There is also an empirical literature on capital allocation that confirms these modeling insights. As far as the cost of capital is concerned, there is very rich literature showing that there's a positive link between ESG and accounting-based corporate performance, that lower cost of capital and higher institutional shareholding follows ESG improvements. There are also a number of studies looking at the cost of capital that is extracted from the analyst forecasts that find that there is a higher cost to companies that are poor ESG performance. And there's also a strand of studies that look at the realized return of ESG strategies, and you expect the higher performing companies in terms of ESG performance to attract ESG investors and reduce and have a reduced performance as a result. But this is not exactly what you find in the studies, and recent work has explained this through the impact of investors switching to ESG and leading prices higher through pressure. So this effect does have is in the opposite direction of what you expect, and in the end, it's hard to detect a higher return from ESG, low performance in terms of ESG and climate that would indicate that the cost of capital for these companies is higher. So that's what the studies on the cost of capital have found. So generally, the model insights are borne out by the empirical observations. As far as reform is concerned, there have been a number of studies showing that there is a link between decarbonization of the economy and the extent to which there is a public equity market development in the country. There have also been studies finding that in the last, in recent years, the second half of the 2010s, the holdings by institutional investors of high emissions industries has fallen, and that following that divestments, lower value for the affected firms has been observed, but also reduction by the affected companies. There has been an activity, apparently, of reform going on, leading to higher carbon abatement by the shunned industries, as well as higher green investments. These are observed on public markets, not on private markets. And recently, there's been a study of mutual funds looking at decarbonization trades by mutual funds. And this has evidence that there was a price pressure on the higher carbon intensity companies that was depressing prices and leading those affected companies to improve their emissions performance. So the empirical evidence suggests that there is indeed an impact that can be felt from the capital allocation activity of investors. So that's the first investor impact channel. The second investor impact channel is engagement. The academic literature there looks at the determinants of attention to stakeholder requests. And the primary model identifies power, legitimacy, and urgency as important stakeholder attributes that will predict the saliency of requests. This model has been extended to look also at the attributes of requests and organizations targeted by the engagement activity. You would expect the demographics of the targeted companies to have an impact, as well as their history of being engaged. The management values could also be affecting the response of companies, as well as the context in which companies operate. You would expect that companies facing retail customers would be more sensitive to pressure and bad publicity that can result in the context of engagement. So I will show you what the empirical results are on these issues of stakeholder and request saliency. There's also practitioner literature that looks at how best to conduct engagement, and that underlines the importance of having some clearly structured dialogue with clearly communicated issues, expectations, and transparency on the engagement process. So that's the academic literature on engagement. When you look at the empirical literature, there is a limitation that you have to be aware of, is that there is no significant database of stakeholder engagement. So most of the studies look at the performance of a single investor. So it's different type of evidence as that used for the study of capital allocation. Now, nevertheless, these studies of investor practices and successes have identified a number of success factors for engagement. As far as the request is concerned, the most important criterion seems to be the legitimacy that of the request, and that legitimacy is enhanced by a good business case demonstrating to the company that it makes sense to be a better climate performer. Obviously, it also helps if you can appeal to norms in the industry, and you engage on a theme that is currently popular and enjoys momentum. So that's how to the impact of the request on the response. And obviously, unsurprisingly, the lower the implementation cost is, the higher the success rate is found. As far as the shareholder doing the engagement is concerned, and looking at what makes it more successful in its engagement activity, Also, the main result is that legitimacy is key, and that legitimacy can come from the status or the reputation of the investors, and that includes the staff that is allocated to do the engagement. There's power that is created from the size of investors, and that can be increased by having investors approach companies collectively in coalitions. And it also matters if the stakeholder doing the engagement have a history of successful engagement. Finally, if you look at the success factors for the engaged institutions, you will find that the larger the size, the higher the potential success, the higher the financial slack, the higher the possible success. The more dependent a company is on reputation, the more affected it will be by engagement. The more room it has for progress, the easier it is to engage successfully. So the idea is that you shouldn't engage leaders, but rather those that are lagging. And companies that are exposed to legal pressure and are not so good at lobbying will also be more affected by engagement. It also helps if the values of the engaged companies are aligned with your requests, and if the company has exposure to engagement, especially if this engagement has been successful. So this gives you a number of success factors that can be useful when preparing and following up on engagements. In terms of impact of engagements on climate performance, there is a survey of the literature done by Kerbel and co-authors that has identified a total of 5 studies showing success for engagement at a rate ranging from 18% of requests to 60%. Now, this is not a bad range, but they've also found in these studies that when you engage in terms of environment, it's not as successful as if you engage on social and governance issues, and also that transparency requests for more disclosure are much more successful than requests for material changes, which obviously may be significantly more expensive to implement. So that study that has a 60% success rate overall show, if you look closer, you find that when this is a material request, the success is only 17%, and that the success is significantly lower for engagement in relation to the environmental performance of companies. So there's still limited research on engagement, and it's limited by the data. Authors doing surveys of the engagement impact literature agree that there is more work to be done to determine how successful engagement is. By saying so, I'm not saying that engagement cannot be or hasn't been successful. Obviously, there are some examples of successful engagements, but I wish to underline that there is this conventional industry wisdom that says that engagement is the only way you're going to get a result. It's far more superior to what you can get through capital allocation. But the extant academic literature, whether in terms of modeling or in terms of empirical results, does not fully support this idea. In fact, viewing engagement and portfolio construction as either or or independent activities is probably counterproductive. There is a seminal contribution by Eschmann on exit, voice, and loyalty that underlines that the voice approach, the engagement approach, is appreciably strengthened by the threat of exit, so the possibility of divestment. After this seminal model, most theoretical models analyze engagement and divestments as complementary activities. And there's also survey results finding that investors practice both, and consider that divestments can be a very powerful disciplinary mechanism for companies when engagement fails. So since the potential for investor impact increases with the convergence of investors, and we can define this convergence both by capital allocation and engagement, we do recommend the approach to investor impact channels to be synergistic and combine and combine and integrate it to increase the potential for impact. Now I'm going to take a closer look at those net zero investment standards. As I said earlier, both standards are meant to support real change in the economy. They're not only intended to align the portfolio to net zero in terms of performance of companies, but they also wish and try to have a positive impact on the performance of companies. And we do not see them as we see them as being complementary. And actually, the Paris Aligned Investor Protocol does mention that the Paris Aligned, the PAII framework does mention that the NZAOA protocol is useful for target setting, and likewise the Net Zero Asset Owner Alliance protocol recommends the use of asset alignment criteria defined by the PAII framework to determine what companies to approach. So these two frameworks are not to be opposed. They can be used in a complementary manner. First, I'll say a few words about the PAII framework. So really, we are seeing here a top-down model that translates the net zero commitments into capital allocation and engagement actions linked to alignment criteria at the level of assets. So there are a number of components in this net zero investment framework. There is governance and strategy, where investors are expected to spell out their net zero emissions goals and adopt a strategy that is consistent with these goals. Then there is a setting of portfolio level targets over up to 10 years for that have to be consistent with 1.5 degrees Celsius scenario. Then there is strategic asset allocation that includes consideration of climate issues alongside standard portfolio return and risks considerations. And then there is the asset class level alignment, which is approached by the assessment of assets in key sectors relative to the sector pathways, and the setting of 5-year targets for increasing the share of aligned or aligning or net zero performance assets. And so there's this targets of alignment in the key sectors, and there's the requirement to have 70% of the finance emissions in those key sectors to be either net zero or net zero aligned, or from engaged assets. So it's either invest in companies that are aligned or engage those misaligned companies. And to reach this portfolio alignment objectives and to reach the investor impact objectives, there is a combination of portfolio construction. Specifically, the framework recommends positive weighting in relation to asset alignment criteria and climate solutions revenues. There is an engagement approach that needs to be clearly linked to capital allocation. So there's a synergy that is underlined between engagement and capital allocation. And there's the possibility of excluding companies that are not responding to engagement or that are no longer compatible with a net zero objective, or for risk management reasons. There's also an advocacy and market engagement component that has to be aligned with net zero. So something very top-down, from strategy to evaluation and of asset level alignment and promotion of alignment by companies for capital allocation and engagement. A very coherent framework. The target setting protocol of the NZAOA is focused on setting targets in four sectors, in four areas, three of which you have to have at least three areas covered. One area that cannot be waived is engagement targets. The objective here is to increase the number of companies that are aligned with net zero. Interestingly, the success is not measured relative to alignment criteria, but by the taking up of science-based targets by companies in the portfolio. And there is an activity target whereby investors are required to engage the top 20 contributors in the portfolio, or those responsible for 65% of the financed emissions in the portfolio. And that framework describes the possible activities in terms of engagement, and that covers bilateral engagement, sector engagement, asset manager engagement, and also the writing of position papers. So there's a couple of ways you can achieve your engagement activity targets. Then there are some sub-portfolio, not all asset classes are covered, so they call these sub-portfolio targets. The reductions are defined very precisely. It has to be 22 to 32% reduction by 2025, 49 to 65 by 2030. That is consistent with an ambitious 1.5 degrees Celsius scenario. And these emissions targets are to be achieved by a combination of engagement and capital allocation, but the difference with the PAII framework is that engagement is really the only tool that is viewed as having a potential to impact company performance, and capital allocation is simply viewed as a way to align the portfolio. These high-level targets are translated into sector-level targets. The idea is to promote progress in all key sectors of the economy, and these targets will inform engagement and capital allocation. This is still quite new for investors, and investors are allowed to not define any targets in relation to sectors, but if they do, they also allowed to ramp up their coverage in terms of portfolio all the time. Interestingly, the protocol provides some sector scenarios and sector KPIs to guide portfolio construction within each sector and define how success will be measured. So that's quite useful. and that's something that was not performed in the context of the PAII net zero investment framework. Finally, there is a fourth dimension that has to do with financing transition targets. There, the objectives are minimal in terms of ambitions. It's just a matter of contributing to the alliance's transition work, so participating in meetings, in position papers, etc. There is no objective to be set in relation to investment in climate solutions here. This is arising from a concern by the alliance that this may cause a price pressure on this investment that would be detrimental in terms of performance for investors. So if we compare those two frameworks, we see coherence in terms of overall objectives. We see more guidance being given in terms of objective by the protocol. In terms of climate solutions, the net zero investment framework requires the setting of targets, whereas this is something that the protocol avoids. There is the underlining of the importance of decarbonization happening at the sector level, and portfolio alignment tools are used for intra-sector allocation. The implicit assumptions here is that you try to be sector neutral to ensure that there is progress within each sector, unless the sector has to disappear for transition to net zero. In terms of capital allocation recommendations, the net zero investment framework is very precise and constraining, especially for passive investment strategies where you need to have a positive weighting in relation to climate alignment criteria and revenues. There's much more freedom in the context of the NZAOA protocol. Engagement targets are defined in terms of activity and asset alignment for the framework, where it's just a question of activity for the protocol. As far as engagement management, it's integrated for the framework, and there has to be transparency in terms of process and voting results. That's not as clear how this is related to capital allocation for the protocol, and there is no transparency of the voting record. Likewise, for policy advocacy, there's the requirement of alignment for the framework, and for the protocol, there's also the expectation that activity will be aligned with net zero, but it's not as strict as in the case of the framework. I mentioned asset level alignment. How is this assessed? And this is in relation to a number of criteria, current and forward-looking. 3 criteria among the core criteria have to be used for evaluation of all companies, and these correspond to companies having targets that are consistent with net zero in the short and medium term, having emissions performance that should be as close as possible to the objectives, and have emissions disclosures of scope 1 and 2 and material scope 3 emissions. So these are the key alignment criteria for all companies. For companies that are in key transition sectors, there's also need to be a net zero ambition, decarbonization strategy that is clear, and some capital allocation alignment that is consistent with the net zero transition of the company. So these net zero alignment criteria for companies are required for the assessment of alignment in the PAII framework, and they are recommended as well by the protocol for assisting engagement and portfolio allocation. So we really have a PAII framework that is a top-down model very ambitious, where there is a clear link between capital allocation and engagement. All of this linked to asset level alignment criteria. So you have a top-down support of change. The protocol is less ambitious and more flexible, but it does provide a lot of guidance on how to set sector level targets. So to that extent, it's very useful, and it also gives examples of engagement activities. A final word before I leave the floor to my colleague Eric for questions and answers. What are the implications for equity investment management? At the portfolio level, you need to have a 1.5 degrees Celsius pathway, so compression of 7% or more per annum. This is to be achieved sector by sector, not by cheating and under allocating to important sectors. The coherence between the portfolio construction, engagement, and advocacy is encouraged. Portfolio construction obviously is used to direct capital to leaders, reduce risk of transition and stranding. It does help to align the portfolio with the net zero objectives. It does incentivize change at the level of companies, and that also contributes to alignment through progress realized by companies. And in the context of the PAII framework, you have this very clear linkage of weighting at the stock level to alignment criteria and climate solutions revenue. This is for portfolio construction, engagement, and policy advocacy should also be aligned with net zero. And the distinction between the two frameworks is that the PAII framework does underline that engagement should be feeding back to portfolio construction. So I've taken a little too much time, and I will leave the floor now to my colleague Eric for questions and answers. Thank you.